Okay, it's 6 p.m. So why don't we start? Good evening, everybody. I'm Scott Saiki. I'm the state representative for the Ala Moana Kakako downtown area. And with me tonight is Senator Shari Moriwaki, who represents the same area, as well as Waikiki. And we want to just welcome all of you for joining this virtual town hall tonight. We're going to be discussing a very, very important topic. And we're pleased to have with us the director of the Hawaii Insurance Council, Allison Uaoka, who helped us organize this panel tonight and who will introduce everyone and also moderate the discussion. We want to thank everybody for the questions that you submitted to us early. There will also be an opportunity to chat questions this evening. So we want to minimize the intro and get straight to the program. So Allison, please take it away.
Thank you, Speaker. Thank you, Senator Moriwaki, as well, for joining us. I'm very pleased to be here this evening, along with a great panel of experts to talk about condo issues. To the panelists, thank you again for volunteering your time and expertise on this very hot topic. And to the attendees, thank you for your interest. As your moderator, I will introduce the panelists and each will be posed with a question. They will have 3 minutes in which to respond, and then we will spend the rest of the hour addressing questions that were submitted by you. At this time, I will introduce the panelists in the order they will speak. John Fujinaka, licensed insurance agent with Pyramid Insurance Agency. Keen Muranaka, Assistant Vice President, Risk Control and Claims Management, Atlas Insurance Agency. Ellen Little, Vice President, Consumer and Mortgage Loan Origination Division Manager, Hawaii State Federal Credit Union. Alan Blades, AOAO Risk Consultant, Atlas Insurance Agency. And finally, me, Allison Uaoka. I am the President of Hawaii Insurers Council. I am going to read the question for the first panelist, for John, and then you go ahead, John, and you have 3 minutes to answer. What kind of condo insurance are owners required and not required to obtain?
Good evening, everybody. Thank you for the opportunity to speak. Starting question is just generally why insurance? Number one is the first one would be required by law. What insurance is required by law? That's what we want to first investigate. Is there a requirement on the condo side? So you want to double check your condo docs and any type of documentation and speaking with your insurance professional always just to check with them. Next would be required by contract. Contract would be something like if you had a mortgagee or again by the condo docs requirements of the association. And finally, for personal reasons, you have your personal assets. For that peace of mind, don't you want to protect that? What would it take to protect that and keep that peace of mind? So those are generally the first three that I want to start with and visit. Next, again, speaking with your insurance professionals and anybody that can give you that guidance. Are you an occupant of the premises or are you a renter? So understanding that difference, because we want to make sure the vacancy is correct, because the product does differ. There is an actual homeowner's policy or condo resident policy. And then there's a policy that's designed for rental policies or even properties that are temporarily vacant or maybe long-term vacant because there's some investor properties or properties that are just held for real estate purposes that are not actively occupied. That can pose unique challenges, especially with claims, because if a water leak starts happening and nobody's there, who's going to get into that property as quickly as possible? So we're going to go with something that's really simple, like a simple HO6 policy that generally the starting homeowners are going to get, generally recommended by your lender, but also insurance professionals are going to jump right into that. It's just a simple homeowners policy that's comprehensive, generally covers for your personal property. What is that? Take the unit upside down, turn it over like a salt shaker. Anything that falls out is your personal property. That's what you want to cover for. Next would be the physical structure or the interior walls in. Things like carpet and any types of updates and alterations that you've done beyond the as-built. But that's where it gets tricky. You really want to speak to your association and go through your condo documents because that will detail what the wall's in. Lastly would be the liability, simple trips and falls or property damage to other. As an example, say your toaster catches fire and causes damage to an adjacent unit or another person's property, that would provide coverage. And a unique situation, we had a party. Somebody threw a bottle off over the balcony. Negligence, of course, hit a car downstairs, caused property damage, or unfortunately hit somebody, causing bodily injury. That liability would be part of that HO6 policy. So those are always just a great start. And again, looking for those additional coverages and then considering what else might be important to you. Again, is there additional liabilities that you're concerned about? Is there additional personal property that you're concerned about? Have you done modifications to the condo itself that you want to protect? Always speak to your insurance professionals, start there, evolve from it, ask questions. Don't be afraid to ask the questions. You deserve it. You purchase a policy like any other product. You buy a car, you want to know the ins and outs of that car. You buy a house, you want to know to make sure that house is well taken care of. You buy an insurance policy. What is it truly covering? What is it not covering? Do I need to add on more? Hurricane insurance, flood insurance. What is the difference between water damage and flood damage? Because there is a difference. What is the difference between wind damage and actual hurricane damage? Because there's a difference. So there's a lot of ins and outs with that insurance, but definitely always start asking those questions. And if you're not sure, ask more.
Thank you, John. Excellent. Keen, you're next. Who is responsible for a condo loss? The AOAO, the owner, or a third party?
Thank you, Allison. So ultimately, the AOAO is responsible for covered damages for all as-built components of the structures of the building as the units were originally built. And that's what Jonathan had touched upon. It may not be how the unit was recently purchased. It may be remodeled or upgraded. As-built should be defined in the condo docs, but will generally include all the common or limited common elements such as finished surfaces, such as cabinets, painted walls, flooring, but not including any upgrades. If it was customized, those customized upgrades will be allocated a standard grade material in terms of cost by the AOAO adjuster. The AOAO master policy will generally be primary in terms of building items. The AOAO master or building policy generally only pays for building related items that are permanently installed. I like Jonathan's example. I've used that in the past where you turn it upside down. That is a good terminology. One thing that I would like to point out is that the unit becomes, if the unit becomes unlivable or untenable due to water damage, the master policy does not provide coverage for additional living expenses, which is the cost to put you in a temporary unit or hotel, loss of rent for claims for units that are being rented out. The master policy also does not cover contents for the individual unit owners or renters. The unit owners or renters must obtain their own personal policies like the HO6 or the renter's coverage. And that is who you should be going to is people like Jonathan. I will be covering how the payments of the water damages are handled in the Q&A session of tonight's meeting, as this is a bit more complicated. We do have other issues to take a look at. But one last item that I was asked to comment on was the responsibility of the AOAO does not include maintenance of the interior building items. It is up to each unit owner to maintain building items during the component's lifetime due to wear and tear. Examples of this could be the carpet, the flooring, the dishwasher, cabinets, your toilets. So that kind of stuff should definitely be covered under your, should be covered on your own and not by, shouldn't be the association or the master policy. Allison, back to you.
Thank you, Keen. That was really good. And I think a lot of questions are specific to specific claims. And I think as we get in the Q&A section, when Keen comes back around to it, he'll be able to explain that, you know, in this kind of panel, we're not going to be able to talk to every specific claim, just in general terms, how things work, so that you know that. Ellen, you're next. How are
Hi.
changing federal regulations affecting the condo market?
So from a lender's point of view, there is several things that you need to know about how we go about reviewing condo projects. So there are national guidelines that all lenders follow. So you've probably heard, it's been on the news again about the partial collapse of that Champlain Tower South in Surfside, Florida. That prompted an update to how we are required to review condo documents. So while there are guidelines, Hawaii State, other credit unions, and local banks, we do have some flexibility to deviate. However, anything that's going to impact the safety, the soundness, the structural integrity, the habitability of the building is scrutinized very closely. The financial viability or marketability, those also have impacts. So if there's litigation within a condo project, we are primarily focused on any of those items, the safety, the soundness, or if there's structural issues. Critical deficiencies like the water issues that can cause damage to a project building, as well as other items that will need repair. We are now reviewing aging buildings to ensure that there are no critical repairs. I don't know if you're aware, but 78% of our condos here have been built before 1980, and there are still 300 plus projects that don't have sprinkler systems. So as you can imagine, the water damage claims are definitely on the rise. So for those that are currently in a condo project, if you have HO6, you might want to get with your insurer to see if you do have water overflow protection. The other item that we review closely are condo budgets. So we want to make sure that there are enough reserves for the normal repair items. Nationally, there's a 10% requirement, though Hawaii State and the credit, we may deviate from that. However, we still review for those increased operating costs as it can, if it's been accounted for in your budgets. If you're in an old condo, pipes may need to be replaced or sprinkler systems installed, and those are very costly and can impact your HOA fees. So if your budget isn't done properly or if the money isn't spent correctly, this can have, a very impact on what you are paying. So I know Hawaii State has done commercial loans recently for repiping, so spread out over 30 years, but the water issue is certainly an ongoing problem. So make sure that you are staying in attendance to your board and that you're reviewing those items closely to know what could impact not only your building, but your individual monthly dues as well. Thank you. Back to you, Allison.
Thank you, Ellen. Alan, you're next.
Oh, okay. Thank you, Allison.
Mm-hmm.
Good evening, everyone.
Let me
Happy
read
Thursday.
your question.
Oh, I'm sorry. I have a question. Okay.
Let me read your question. What can AOAOs require of owners to maintain their units?
Well, the maintenance of the units are very important. One of the most important things you guys need to look for is water leaking. So you want to check all of your water inlets, the lines in your toilets, the lines under the refrigerator that go into the ice maker, and also the lines for the sinks in the kitchens. Some of the best things you can do is, at least maybe once or twice a month, is take a look at your pipes, make sure you don't have any condensation or any leaks. And a better thing that you can do is actually purchase moisture sensors. And they're pretty cheap. You can get them at Home Depot or Lowe's. And you just slide them under the sinks, put them behind the toilet. And if you do have a leak, it's going to sense it and you're going to have that little annoying beep. But that'll give you an idea that there's something wrong with the water lines or the water valves. And you may want to check them or have them placed. Another thing to look at is maybe once a year, you may want to check the wax ring on your toilet because that's an important thing. It's a very small thing to check, pretty easy. Most people could do it themselves. They can hire a plumber, it costs you a couple $100, but it could save you thousands of dollars in damage if you have that rack spring replaced. The other thing that you might want to look at is what is your light switches and your light bulbs. If you see your lights flickering, check the light bulbs. If the light bulb is screwed in and you're still having flickering lights, it may be an electrical problem. You may want to have an electrician check it out. And the other things is just to watch the baseboards, because sometimes water that's leaking is leaking from a common area pipe. If it's a common area pipe, it's going to build up at the bottom of the baseboard. And depending on the type of baseboard you have, you can actually see a warp in the baseboard, but you won't see any water. So you may want to check your walls, look at your baseboards, and just make sure they're not warped and there's no soft spots in the walls themselves. And that's pretty much it. One more thing that you want to do, and this goes back to your condo docs, is when you're doing any changes in your unit, you want to make sure that you're following what your DCCRs or your condo docs are allowing you to do, because sometimes people will make a change in their kitchen remodeling and it's something that's not supposed to be allowed in your condo doc. So that's very important. Know your condo docs. And that's about it. Back to you, Allison.
Thank you, Alan. I have one follow-up for you, Alan.
Sure.
Can the AOAO actually require the owners to do certain things like plumbing inspections, like replacing water heaters or things like that?
At that point, it would be a suggestion or it would be a request. They cannot force them to have this done unless it's written into the documents under the DCCRNs or the bylaws. It has to be either an amendment and it has to be a part of the contractual agreement that the owners enter into at the time of purchase. So if it's not a part of the covenants, no, they can't make them do an inspection. So this is one of the things that we've been working on, is offering inspections to our AOO clients. And this is something that's going to help everyone, because we look for every possible risk before it becomes a hazard, and we try to have the hazards to prevent them from becoming claims. So basically, no, they wouldn't be able to force them to have the inspections.
Thank you, Alan.
You're welcome. Thank you.
The next subject is for me to cover, and this is the law that the legislature passed in 2022 regarding condos. And the reason the legislature, I believe, looked at these issues were to see if there were things that the legislature needed to enact so that the owners of units and condos would have some standards for doing things, because I think many boards and many buildings sort of operate differently. They operate independently and they're not standardized. And so that some buildings might actually have their property managers do the reserve studies, and some may have independent reserve study people do it. They also may not do that reserve study or update it regularly, and some may. So there's some inconsistency there. And I think that the legislature wanted to make sure that there was some protection, more protection for owners. So they passed House Bill 2272 as Act 62. It's effective January 1, 2023. And these are the highlights in the bill. The first one is that it specifies that a condo deck may be amended by 2/3 of the owners or a higher percentage if required in the declaration. I think the law may have been unclear, so that's a clarification. The second one is to require the developer's public report to include the annual reserve contributions based on a reserve study as part of the breakdown of annual maintenance fees. And this was also to clarify when a new building is built, what the components are in the maintenance fees. The third one is to specify that the association's cash flow plan be based on 30-year projections. This is an increase from 20-year projections. So this is actually a more robust reserve study, and more items would be included in it, so that some buildings may be not want to put in everything into the 20-year plan. They push it out to year 23 or 24. You're not going to be able to do that in a 30-year projection. It's more robust, and I think it's probably better for the building. And finally, it requires the reserve study to be reviewed by an independent preparer and updated every 3 years. Sometimes property managers or board members decide to modify the reserve study, and then it's not actually the study that was submitted originally. So that can be quite dangerous. So this sort of prevents that. And I think that this is a good start for trying to protect buildings more in the future. I suspect that there will be more changes to the law along the lines of this. Thank you, Rona. So now we're going to move on to some of the questions that were submitted by the attendees. And the first question is going to be directed to Ellen. And that question is, how and who should respond to lender questionnaires on structural integrity of the building?
So you see the questionnaire, which we call the RR105C, that is completed by the managing company. So they're the ones completing it. So they're going to have to do, as best they can as far as the structural integrity. That's, a little harder. If it's an older building, if they're starting to have more, water damage claims, it's probably a sign that something's going on and they should have it reviewed. But without actually having it reviewed, they probably aren't going to know how to answer it, and they'll probably just say, no, there's no structural issues. So that could be problematic later on, though.
What happens, Ellen, if nobody wants to respond or sign that document?
Well, we do for lending purposes. It's required, especially on a purchase. So we probably would have some other means to complete it, but because we're under strict guidelines, there are questions on that form that have to be answered. So if they refuse, we would probably not do the loan, because that could be indicative of something bigger going on with that particular condo project. And we have to think of the owners who are purchasing, that it's for their safety. There could be something going on.
Right. Thank you, Ellen. The second question has to do with paying water claims, Keen. And before I read you the question, let me take a quick look at the chat, because I have some questions that have come up, and a lot of them have to do with water damage. So the question is, who is responsible in paying a water claim? When is the owner responsible and when are they not? One of the follow-up questions to that, Keen, is who pays the master policy deductible? Another question sort of related was, a carrier said they refused to pay for sewer backup. And there's a scenario here. If there is a water incident in one unit that causes $50,000 damage in each of 2 units with a $100,000 deductible on the master policy, does the HO6 pay for both units and the master policy doesn't pay at all? How's that for a loaded agenda?
Yep.
Okay, go at it.
Okay, so let me start by answering maybe a little bit simpler, or let me give you the background. So first of all, who is responsible for paying for the water damage? It really depends on how it occurred, but in most cases, it starts from a source unit. So I will center my discussion around that scenario. And this leads to the next question as to when is the unit owner responsible and when they are not. Master policy or homeowners? Okay, good questions. This is where it gets complicated and stressful. The driving force behind the covered water damage claim under the HRS 514B 143D, very simply put, is the statute that boards have 3 options. So the first option is the association may choose to pay for the damages as a common expense. And to tell you the truth, I rarely see this used. The second one is, after notice and opportunity for a hearing, assess the deductible amount against the owners who are responsible for the damages or for whom whose units or damage or cause of loss originated. And I basically see this used almost 90% of the time. And the last one is require the unit owners affected to pay for the deductible amount. Now, I haven't really seen that used as much, but it does come up every once in a while. So here is a simple example of how it may play out. So a unit 3 is the source unit of the water and causes damages to units 2 and 1, which exceeds the unit, the AOAO deductible of 25,000. So unit 2 and unit 1's combined damages are $75,000. Unit 3 sustains no damages, which is the very top unit. So in this example, the master policy pays $50,000 in the covered damages, and the AOAO can assess the unit 3 for $25,000, which is the deductible. And unit 3 will generally submit his assessment letter to his HO6 carrier, and in general, the HO6 carrier will pay $25,000 less their deductible, or may choose to pay the full amount, depending on which coverage component they will pay it under. The problem is that these deductibles are increasing so much that it exceeds the loss assessment coverage of most local carriers are offering. And it's leaving the insured with greater exposure and causing the insurance carriers to walk away from certain deductible levels in writing the HO6 policies. What we're also seeing in the master policy arena is that policies are increasing their deductibles. 50,000 or more is not uncommon these days. And now we're seeing hybrid deductibles with per unit deductibles of 10,000 to 25,000, some with a minimum of 100,000 in total, and some with a maximum deductible of at least, I've seen it at 500,000 right now as one of the maximums. So it's creating this dilemma for the board of directors is, whether or not to charge higher maintenance fees to cover the increased cost of the master policy. John came up with a good example in his one. And and this is to keep the deductibles as low as possible. So they're willing to pay a higher policy premium on the master policy. The other issue is, or do they push the unit owners to absorb the cost of the high HO policy premiums? So it's a very tough area to be in. So, the market is not getting any better right now, and there's no clear-cut answers. It's probably going to be in a happy medium of some sort. As far as that example, that's the most common that I see. Allison, if you want to repeat that question regarding that loss where the master policy deductible was not met, what was the question on that?
If there's a water incident in one unit that causes $50,000 damage in each of 2 units with a $100,000 deductible on the master policy, does the HO6 for the both units pay for the deductible? The master policy doesn't kick in at all.
Well, that example that I gave basically covers it. The association has the 3 decisions to make, whether it's the association pays it as a common expense. But again, the more common answer that I find is that they'll take component 2, which is to assess the source unit. So that source unit would get assessed the full deductible. And then when the monies are returned to the association will generally divvy up the money until onto the 2 damaged units. So that's the common way that I see it occurring at this point in time.
Mm-hmm. So in this example, then, if there were 2 source units, they would each pay whatever proportion of the damage, and the master policy actually, it's still
pays nothing.
Deductible.
Right,
Right.
correct.
Correct.
So in that case, if it's 50,000 total, they each will be assessed 25,000 if it's 2 source units.
Right.
and you know, that should cover the covered components.
Okay, I have a follow-up question regarding that, Keen. In a water loss, when you know where they have to dry out some walls, they bring
Yep.
or ceiling, they bring in these huge blowers. And the question is, when there is a water damage event, who pays for the added electricity to remediate the units with the blowers? And they are on, you know, they are on like 24/7 for could be as long as a week.
Right. So in those cases, the master policy should cover that as an expense on the remediation and costs for the unit. So to extract the water, that's part of the cost. And so the master policy should take that into consideration.
So the AOAO should pay for that.
Well, yes, the AOAO should be paying for that, but they should be sending that bill to the master policy carrier, because that's a component of the remediation.
Yes, in
So
terms
that
of
should be
covered
added to the
loss, it's a
total,
covered
right?
loss.
It's a covered, yes, it's a covered loss, provided it's a covered loss, yes.
Thank you. Thank you, Keen. Moving on to the next question. This is for John and Alan. And this sort of follows the line of questioning that Keen had about what to do about the hardening insurance market and increasing deductibles, also including insurers who will not insure certain buildings because of their losses. So who wants to go first?
Go ahead, John.
All right, well, I'll start off first with the two types of insurance that we're looking at here in Hawaii. Generally, there's going to be the direct market carriers, where you basically can go online or open a phone book and start calling around for the direct carriers that will do business directly with this consumer. The second type of insurance is the agency carriers, where you're actually dealing with independent agents that have access to multiple different insurance carriers. So that's where you're going to first start off with, because there are people that go direct and there's some people that work with agents. So that's question number one, is who's competitive? And you won't know until you do your shopping. So if you want to undertake that task by going around and doing your calls and so forth, you can go to these direct carriers in hopes to find good coverage. The question then becomes is, what kind of answers are you going to get from them? How well are they able to decipher the policies and explain it to you? Because again, it may be a call center, or it may be a person that might not have as much experience. On the agency side, you will be dealing with insurance agents that are licensed, like myself, that may be able to provide you more in-depth answers and more information. With that, because of the hardening market, if that direct carrier is unable to insure your building, you're off on your own. You're going to have to go searching again. With the agency side, if one of our carriers says we're unable to do that, our agency can then jump in and look for another carrier on your behalf. So you're not totally stuck. And the agent has that responsibility to continue to search the markets that we have available to find a potential replacement policy. Now, the hardening of the market is because of, number one, inflation. Let's be realistic. We've seen some of these commercials, and these commercials are 3 to 5 years old. And in the last 2 years, we have seen exponential costs rising, and these commercials have never been updated, you know, that 15% or more. But, you know, that's unfortunately not how it is now. We are seeing original policies going from $150 to $200 to now $400 to $700. These are what people are paying annually. Now, imagine the same thing is happening to the associations themselves. They were, let's say, paying $100,000. But due to these claims, due to the losses, due to the inflation cost to do repairs, the premiums are now $1 million. That's 10 times the cost. That then gets translated back to the consumer in their association fees. You're going to see your own personal HO6 policies increase, as well. Now your association fees start to increase. Then you add on the fact that your deductibles have now gone up from $10,000, $25,000, $50,000, as Keen mentioned, as high as $500,000. How is that going to be covered? So we are in a very difficult market. A lot of the carriers are reassessing how high are they willing to pass that off to the consumer, and the responsibility up to that deductible. And basically, again, what that just means is that they are not responsible for any damages below that set amount. So if that set amount is 25, anything up to 25,000, you're on your own. If it's 50,000, you're on your own. If it's 100,000, you're on your own, and hoping that you have an HO6 policy that covers it, or you're prepared to just pay for that out of pocket if you are not required to have insurance or you don't have insurance. So always ask the questions. As we talked about earlier, going through your condo docs to find out what your insurance deductible is and what you are responsible and not responsible for. Alan?
Actually, I think you pretty much covered it, John. There's not really much that I could add to it because the biggest thing comes back to your condo docs. Find out what you have to have and make sure that you're adequately covered. And then that's about all you can do. And hope and pray that you can actually find a policy and somebody to cover you because it's getting harder and harder every week. So yeah, I think you pretty much touched on it. Yes,
Alan,
ma'am.
from a loss control standpoint, though,
Mhm.
what can a building do to reduce their chances of loss in the future?
Well,
What can they do to help themselves
mitigate the possibility of
become more of an attractive insurance risk?
Well, what they could do is that they could actually have a life and safety plan that they either initiate themselves. So it could either be done by the property manager, the managing executive, the site manager, or the resident manager. They don't necessarily have to bring in a third party to do a life and safety evaluation on their own business, on their own building. So I would like to see, and this is something that we brought up with some of the properties that I used to work with, is that you have a covenants inspection. So people walk around and they look for common area, limited common area. They look for violations of the docs, but few people look for risks. So if the condo associations, especially the on-site managers who's there all the time, they manage 5 or 6 buildings, or the resident managers who live in the building, can take an evening stroll, can look at the building itself, look for spalding, look for water leaks, look for holes in the ground, talk to the tenants, ask the tenants, are you having any problems? Do you smell anything in your unit that smells like mold or stale water? Talk to everybody because this becomes a collaborated effort. We all have to work together in order to find the problems in the buildings to prevent them from becoming hazards and risks and claims. So the biggest thing for everybody to do would be just do a simple risk assessment on your own building, at least maybe once a month, once every 3 months. And back to you, Alice.
Thank you, Alan. So that
You're
if you do these kinds of things and your losses
Mhm.
go down, that makes you
Yes.
a better risk, right?
It
In the
seems
eyes
like
of
it would make you attractive. Yeah, in the eyes of the insurer, it seems like if you have a risk assessment plan and you have it on paper and you have it documented as a record, and that you present it to your either your agent or your carrier or your broker and tell them, listen, we actually have a plan that we follow, and every 3 months we do from top to bottom, air conditioning, HVAC, plumbing, electrical. We even have a survey sheet that we give to the residents and ask them to fill this out. And if there are situations in the unit that they don't really know if it's leaking or is it condensation because it's been humid, take a picture of it and let the site manager take it to their engineer and let the engineer look at it, or their operations man or their maintenance guy, and let the maintenance guy say, well, that looks like it could possibly be a leak. Let me take a look at it. So if they can get everybody in the building involved, they can make it a little more attractive for the insurer to look at it and say, listen, you guys are doing your best to prevent the risks and the hazard, which is going to bring down the claims. This is something that we're interested in. This is something we want to help you with. And that this is something that everybody can do. That's one of the things that we're doing here at Atlas with our AOAO clients, is that we're offering them risk assessment valuations of their entire properties. And we've done a few, and it's actually come out pretty good. We found things that nobody even thought to look at. So that may be something you want to do. Come back to us.
Thank you, Alan. I think that this is important because people who are in their buildings now can do things on their own.
Yeah, absolutely.
It doesn't have to be a law. They can do it on their own and make themselves a better risk for insurance. So that helps with a hardening market.
Absolutely.
Alan, stay on there. The next question is also for you and Ellen. What is the impact of fire sprinklers on insurance and lending? So does it help if your building is sprinklered, and how does the lender look at that for Ellen? So go ahead, Alan.
Well, the sprinklers will always be a good tool to fight against the spread and control of the fire. So it's going to be a plus in the insurance. So if you have a sprinkler system, your premiums will be lower, your deductibles will be lower. If you don't have a sprinkler system, you could expect to have high premiums and outrageous deductibles, and it's just going to continue to rise. So that would be the effect of having sprinklers or not having them in your association.
Thank you.
Yeah.
Ellen, what is the impact on lending with sprinklers?
So this is the interesting part. So there's so much focus, right, around structural and integrity of buildings. But the one thing that there isn't any guidance from a lending standpoint, we don't look to see if there's sprinklers or not. We would lend in a project whether it had sprinkler systems or if it didn't. I think for us, it's more of an insurance issue, but from a lending standpoint, we wouldn't restrict lending in any building that did not currently have a sprinkler system.
Okay, good to know. Thank you, Ellen. The next question is for John, and that has to do with premium increases. Why have insurance premiums increased even though the condo has not had claims? So maybe, John, could you talk about the impact on reinsurance?
Absolutely. So this is actually an excellent question because people are not actually seeing the inner workings of how the insurance works as a whole. So insurance is a risk pool where people come in as a community and put in premiums to build up a reserve in essence. Now, think of it this way. There are multiple insurance carriers, but they're not an infinite amount. That means a single carrier could be insuring multiple buildings. So that means one building may be risk-free and maintain a pretty good credit, but maybe 5 other buildings that they insure as well are taking massive losses in claims. This devalues their total cost or premiums that they intake. And that means at one point, they may be losing more money than they're taking in premiums. So the only way for this the insurance carrier to stay solvent or stay profitable or even stay in the market, they have to increase overall premiums in general and then assess the other higher risk buildings at an even higher amount of premiums. So just because your building has been free and clear doesn't mean that the overall product has to move up. And same thing with inflation. We've seen this, the overall inflation cost. Everything has gotten more expensive. But oddly, the insurance in the last 3 years has been the only one that's kind of maintained and then saw a spike. It really maintained for the last 10 years. Then 3 years ago, it started to take a big jump, and now it's really taken an exponential jump. And because the losses are starting to compound, the overall premiums have been well under what they're taking in. And earlier I did a quick calculation for fun. As an example, $100,000 claim, or let's say even something as small as a $20,000 claim. If that individual was only paying $150 per year, it would take that individual 80 years to break even for that $20,000 claim. Now take that same person that was paying $150 and they had a $100,000 claim, that would take them 400 years of premium payments to catch up. That's not feasible. So for a $100,000 claim or even a $100,000 claim, a viable premium would be more in that $300, $400, $500 range. And that's where that exponential jump has come. And so now, as one of the questions that came up, a $50,000 claim per unit, that's $100,000. What if it was 8 units in one single stack that sustained $1 million in losses? And all those units were paying $200 in insurance premiums. That's not even close to cover the actual claims and loss. The insurance company technically is losing a lot of money out of that claim. So we're going to see these calculations start to balance out. How much is that actual loss going to cost? And how much premium do we have to actually charge that building and the overall product to stay in business? If not, they may just not say, we don't want to do this business anymore and pull out of the market. And that's where we're slowly creeping up. And that's why the deductibles are starting to raise, because they're trying to transfer that risk now from the insurance company to each individual party. And so that's where you're seeing that balance right now. And hopefully we find a happy medium. But unfortunately, if we don't solve a lot of these the claims issues and the large claims that just are exponential, again, the repair cost, the loss of use cost, just to get granite countertops and so forth and putting units back to how they were prior, this is costing a lot of money, and the insurance carriers are starting to feel that pain. Allison? Allison, your mic.
Sorry, John. Could you explain what reinsurance is, and could you explain how reinsurance increases impact what insurance companies in the voluntary market charge?
This one's a little bit tricky only because there's just multiple layers with the reinsurance. So generically speaking, there is a company that is willing to put up certain amount of dollars because that's how much money they have in reserve to be able to do that. Once it starts to exceed a certain level, so let's just take big numbers. Let's say $1 million. One carrier says we can handle $1 million. That's how much cash we have on hand to pay out that claim. But say they need to go to $5 million or $10 million, they're going to need additional layers or reinsurers that have that capital to come in and invest. But here's the issue. If that underlying insurance carrier cannot justify to the reinsurers behind them to say, hey, come on, come join us for this risk, they're going to say, wait a minute, you guys had all these claims. You already paid $1 million and your last reinsurer had to pay another $4 million. Maybe we're not too interested. And so you start to lose your market. You start to lose your viability. And that's where Alan was explaining, you need to prove back to the insurance carriers, that you are taking steps to mitigate losses. You guys are doing appropriate repairs. You are doing inspections and so forth. The unit owners as well, that's where some of this goes back as well. Are they being responsible? Is that an Airbnb condo where most of them people are partying like rock stars and just destroying units? Or is it owner occupied where many people are living there? They're taking care of the units. They treat it like their own. And is the units vacant? Is it a 50% vacancy? Because again, it just takes that one on the 5th floor that nobody's living there and the line pops and floods the next 4 units down. So that's where a lot of the reinsurers and the insurance carriers are going to be looking at that and how much exposure, how much dollars can they afford?
Thank you, John. The next question is for Ellen, and it is, can the AOAO require owners to obtain homeowners insurance policies?
I would say that yes, they definitely have the right to do so. We would review the condo docs and the questionnaires to see if that's something that is required. So then if somebody was coming in either to purchase or refinance, we would look at that and make sure that they did have HO6 insurance. The interesting thing from a lending standpoint is all lenders, we cannot require any unit owner to have a minimum amount. If they have an HO6, no matter how small or how large, we accept it as it is, which is kind of interesting. We can't impose anything in that regard. So if somebody is in a building that it's brand new to like 10 years old, we don't require them to have HO6 at all because we figure it's new and you don't have to. We would encourage somebody, to get with an insurer because you just never know. But yeah, we don't impose it.
Thank you, Ellen. That's interesting from a lender's standpoint, but from a building perspective, some buildings require their owners to have homeowners insurance policies, and they also can require a certain deductible amount on the HO6 as well, right?
Correct.
Okay. So I think sometimes maybe what the buildings do, though, even if they have the requirement, they don't require the owners to show proof of coverage. And so then they don't know if the owners actually are getting the right amount of deductible, or if the deductible has recently changed, because that's what's happening in this dynamic market, right? Deductibles are going up.
It's going up.
They could go up overnight. So yesterday it was $25,000 and today it's $50,000, but $100,000 for water damage. And so if the building doesn't check to see if every owner has the right amount of coverage, then they don't really know if everybody's complying.
Correct.
So that exposes everybody, though, in the building.
It does. So that's part of what we look at too with the reserve studies, is
Uh-huh.
that it's very beneficial to all of the unit owners, right? That they're planning for this, that, you know, it's taken into account with all of the water issues that are coming up now. So, yes.
Thank you, Ellen. Next question is for John. John, which insurers specialize in what kinds of coverages? Because you talked about all different kinds of coverage, including, you know, coverage for the building, which is a master policy, coverage for the owner, which is a HO6 policy, and then maybe further coverages that an owner may wish to look at purchasing. So flood insurance or maybe even hurricane insurance. So could you speak to that, please?
Sure. Going back to my original statement about the two types of products generally is the direct markets and the agency markets. They usually have the abundance of coverages that people are generally looking for. Of course, again, you have to ask for it. If you don't ask for it, they may be trying to give you the cheapest policy to get the business, but there's a lot of exclusions. Again, generally, hurricane is excluded, flood is excluded, earthquake or earth movement is excluded, and you need to purchase these coverages back. And you have to make sure you understand what you're getting. So if anybody leaves anything from me today, first thing you do, go home, pull out your HO6 policy or any insurance policy you have, go straight to the exclusions page. I know there's 37 to 100 pieces of paper in there, but turn through it and look for the exclusion pages. That will immediately tell you what's not covered under your policy. By seeing that, then you can feel confident and say, okay, you know what, that's not as important as I thought it would be, or, oh my gosh, I didn't realize that sewage backup is an excluded coverage form, and I need to buy that back. Or, oh my gosh, flood is excluded from my policy, and I really feel that flood is important. I need to buy that back. I need to go speak to my insurance professional. So specialize who it does. It's going to be a little bit of hard work for the consumer because you're going to have to check with each carrier. You're going to have to ask them and be upfront and be honest, because the worst thing that could happen is you're not completely honest about the property you're getting. And one of the biggest ones we see is people wanting to get HO6 policies that are owner occupied, but they turn out to rent it. And when the carrier finds out that it was not owner occupied, that's technically a violation of the policy, and the carrier may decline a claim that occurs in the property because they were not honest about the occupancy. More so, Airbnb and short-term rentals, and now we know that there's been some changes with the short-term rental laws in locations. If that condo doesn't fit in that specific location and the carrier is not aware, they could deny coverage. So if there's a water loss, there's no coverage at all. So again, being upfront and being honest with that agent and saying, this is what I'm concerned about. This is the condition and the situation I'm going to be living at. Can you find me the best policy? And you work together with your insurance agent, rather hoping to find the cheapest possible option and hoping that it covers at the time of loss. Again, if anything, straight to the exclusion pages, that's the best place to start. Allison?
Thank you, John. I have a follow-up question for you as an agent, not specific to this, but it has to do with obtaining a copy of the master policy. So the question is, my condo association asked me to pay $160 to $300 for the common area insurance statement. I'm assuming that means the master policy deck page. If I don't want to pay that kind of money, where can I get a free copy of my building insurance policy? That's different, policy versus deck page. Should I get it directly from the insurance company? So as an agent, if you were writing the building, would you provide that directly to an individual owner, or does that have to come through the property management company or through the AOAO?
That's kind of a personal question and a personal take by the agent itself. Generally, the owner is an owner of the policy, so they have a right to the policy. They should not be neglected of it. So if they request it, they have every right to request it from the property manager, the real estate agent that sold it from them, because they can request it. And I don't see why the insurance agent wouldn't be able to provide it to it as a legitimate owner of the unit. So and the declaration itself should be previewed to the owners and all the unit owners of that property. If I had an owner come to ask me personally, I wouldn't see why it would stop me from giving them a copy as long as I can validate. And if not, if I wasn't comfortable, or I wasn't sure, I would say, as the owner, please reach out to the property manager, because the property manager should be able to provide a copy as well.
Thank you, John. I have a question for Keen. This has to do with the claim, and the question, Keen, is what if an AOAO does not investigate the source of the loss? What happens if the building doesn't do anything?
That's a tough one, because it's going to be a potential issue. But generally speaking, if there is a water damage claim, they want to figure out what the source is, because they want to be able to eliminate that source for the future. So if to me, the AOAO should do an investigation, and they should find out what the source of the leak is and prevent it, because it's going to occur again, and it's going to be a red flag under the master policy.
Thank you, Keen. So, when you live in a condo, it's really everybody affects everybody else, right?
Correct.
So it doesn't have to only be a water loss, though. It could be any kind of loss.
Could be any kind of, yes,
that
could be any
AOAO
kind of
should
loss.
be involved and trying to figure out if there is some common element involved as well.
Correct.
Be causing loss.
Right.
Okay, very good. We're getting close to the 7 o'clock hour, and I want to say thank you very much to all of the panelists here tonight. And Rona, if you could please present the screen with the email addresses of all of us who spoke tonight, so that if any of the attendees have future questions or that we might help you with, that we would be able to do that. And then I want to turn the meeting back over to Speaker Saiki.
Thank you very much, Allison. Thank you to all of our panelists for all of the information. I think I learned a lot tonight. I'll be turning it over to Senator Moriwaki for the closing statement.
Oops. Oops, she's on mute.
I want to also join in with Speaker Saiki, and it's this idea to have this. We are such a condo dense district that you could see how many people joined us. And I want to thank everybody, and especially our panel of experts. We might have a follow-up as we see that a number of questions were not answered, but the panelists did an exciting, really, really well done way of answering all the questions, as specific as they were. And we learned a lot about condo law, but also insurance. And so I do want to thank the panelists again for really good information that we got. And if there are any other questions that we would like to follow up, if you would put it in the chat, if we want to have another session. All of the panelists have agreed to come back if need be. So I do want to thank them once again. It's been a very educational session, and I want to thank all of you who joined us. So mahalo to everyone. Aloha.
Thank you, Senator. Thank you, Speaker Saiki.
Thank you.
Thank you, everybody.
Aloha.
Thank you.
Thank you.
Thank you, everyone. Thanks for having us.
Thank you.
Thank you.